Frontline stocks take a leg down after their heady run, even as mid-caps buck the trend. Industrials, energy and healthcare eke out some gains, but financials and realty retreat.
Weak deposit accretion, especially low-cost deposits, crimps growth for HDFC Bank. A dip in wholesale business also impacts advances. Even as the credit-deposit ratio moderates, the stock slips.
Bajaj Auto is set to unveil the world's first CNG motorcycle in a move that could deliver lower fuel costs with a higher green quotient for customers. But the pricing of the CNG ride remains key.
Mahindra Group and Volkswagen are likely to elevate their partnership into a joint venture with a focus on developing and procuring electric vehicles. Sources tell CNBC-TV18 this will spell a shift away by Volkswagen from earlier talks with JSW Group.
And Siemens AG boss Roland Busch tells CNBC-TV18 that global inflation is likely to remain higher than previous decade due to energy transition costs and due to companies moving out of China. Adds he sees robust capex growth in India.
Hello and welcome. You're watching us here on Halftime Report. We're halfway through the trading session. It's got all the makings of what a trading session is. It was volatile. It recovered from lows. The frontline indices seeing some bit of moderation continuing from yesterday. And we have the mid-cap index, which continues to do well. So today's decline can be single-handedly attributed to HDFC Bank, because of which the Nifty bank is lower. But barring all of that, HDFC Bank, we have seen a lot of other pockets do well for the market today.
They are actually. And if you talk about those pockets, it's the CPSE index which is surging in how. And it's the second day continuously that we're seeing a lot of traction in that space. So that index is up around 1%. We have the energy space, so the likes of ONGC, that's up around 3%. We have BPCL, IOCL, GAIL, all of these stocks doing really well. Nifty Pharma has made a comeback as well, so that index is doing well. And while we are talking about how the mid-caps are doing well, that index is up around 0.5%, a major recovery from the lows that we've seen from there. Even the small-cap index is not far behind. That one is up around 0.8%. So a lot of pockets which continue to do well as well. And we've been talking about HDFC Bank, so let's talk about that stock because it's been a big underweight on the markets today. It has declined over 3.5% on the back of its Q1 FY25 update. Abhishek is here with the fundamental details. Abhishek.
Well, to begin with, HDFC Bank came out with its Q1 FY25 provisional business update, which showed that, CASA momentum has been weak for the bank, but it's seasonal in nature and slightly ahead of seasonal as well with respect to one-offs that they have had in Q1 FY25. The LCR has improved. That's a key highlight point. And the credit deposit ratio that continues to decline, which is a good sign for them as well. Deposits are down 0.03% sequentially. Now, system-based, if you see, the whole deposit of the banking sector has declined by 1.65% from March numbers to 14th of June that they have put out as per RBI data. Now, CASA momentum is bleak. CASA has declined by 5% quarter-on-quarter in Q1 FY25. It had declined by 2.75% in the same quarter last year. However, this time around, we have seen sweep-in, sweep-out facilities and, general elections also playing out, which had weighed on the current account deposits of the bank. So CASA ratio as a resultant has declined by 190 basis point on a sequential basis. Advances growth were at 0.8%. It was down 0.8% quarter on quarter, and this was largely due to the fact that other wholesale advances that's declined by 26,600 crore as the management continues to go cautious where the yield is not favorable. Credit deposit ratio that's declined to 104.5% versus 105.4% in the previous quarter. Now, the key positive from here is the LCR or the liquidity coverage ratio, which has improved to 123% versus 115% in the previous quarter. Brokerages do say that deposit accretion was weaker than expected. High rundown in current account deposit was not factored in by them. Credit deposit ratio was flat sequentially. So, Nomura has a neutral rating with the lowest target price at 1,660 per share. Other analysts are bullish on the stock, and the target price ranges from as low as 1,725 per share to as high as 2,100 per share. Back to you.
All right, so that's about HDFC Bank, currently below all the most of the target prices out there, as Abhishek pointed out. But Abhishek, that's not the only financial stock which is under pressure today. RBL Bank too, after its first quarter update, is lower.
Well, they surprised negatively on the deposits front. So deposits have shrunk sharply or, higher than the industry average as well. Deposits have shrunk by 2.1% quarter on quarter. As I mentioned earlier, for the system as a whole, deposit had shrunk by 1.65%. So it's led by sharp decline in CASA as well. CASA in absolute value has declined by 9.5% quarter on quarter, and the CASA ratio is at 13-quarter low, coming in at 32.5% versus 37.3% in the same quarter last year and about 35.2% in the previous quarter. The good part about the business update was the loan growth. Now, loan growth was more than 18% YOY and 3.3% sequentially. This has led to sharp improvement in the credit deposit ratio, which increased to 87.3% versus 82.75% in the previous quarter, which may suggest that net interest margin may pan out well, improve sequentially or remain stable on a sequential basis if slippages are contained. Liquidity coverage ratio is at 137% when compared to 129% in the same quarter last year and about 140% in the previous quarter. Back to you.
Okay, all right. That's about RBL Bank. So a whole host of financial updates that have come by. Thank you, Abhishek, for joining us with that. The other stock on our radar is Shilpa Medicare. One of company's CDMO customer reported positive results from clinical trial of a new molecule for potential treatment of a chronic kidney disease. Vivek is here with the details and the implications. Vivek.
Well, that's right. So Shilpa Medicare is the company in focus, the stock in focus today. Yesterday evening, the company went ahead and updated the exchanges about, one of the clinical trials that one of the company's CDMO customers was actually going ahead and doing. So the name of the company that was doing the clinical trial is a company called Unicyve Therapeutics. Unicyve Therapeutics yesterday reported positive results from a pivotal clinical trial of a drug known as OLC. This particular OLC is a new chemical entity that has potential to treat one of the side effects of treatment of chronic kidney disease patients. So what does Shilpa Medicare, number one, provide as far as services are concerned, to this end client? And number two, what is it that they stand to gain? Number one, they partnered with Unicyve to provide end-to-end CDMO services. Along with that, the company conducts development and supply of active pharmaceutical ingredients to the finished dosage form as well. So Shilpa Medicare will get paid for these services that they provide. Along with that, Unicyve has already placed a long-term binding purchase supply for OLC tablets, and this particular order has come in by June 30th already. Also, there has been an additional order that has been placed by the client. Now, this particular delivery that Shilpa Medicare has to do will be done between December 31st, 2025 to June 30th, 2026. So the company, number one, will receive income from all of these services. Along with that, there is also a milestone payment that Shilpa Medicare will receive of $10 million as, each step of the process is done in terms of filing, approval, as well as launch of the product. Significant development as far as Shilpa Medicare is concerned. No wonder the stock is surging in the session today.
All right, Vivek, thanks a lot for that. Meanwhile, some news on Thermax at the bottom of your screen. That stock spiked about 3.5%. They've won orders worth about 500 crores coming in, and as a result of which there's been an up move. In fact, there's been an up move for the market as well. There has been a swift recovery. The Nifty is now all but in the red, all but in the green actually as we speak, just about 20 points lower. That means it's a big recovery that we've seen from the lows. Maybe something like a Reliance comes up for you. We're seeing some traction out there that's been doing well at the higher end of today's trading session. And some more, movers, big heavyweights. L&T as well has moved to the high point of trade. But one of the stocks which has seen a fair amount of recovery from the lows after underperforming from the start of this year has been Sheela Foam. And we can attribute some of today's move to the commentary that came in from the management here on CNBC-TV18. So there's a special Insight Edge segment where we got a fair amount of insight on the business from the management itself. They're looking at 10% volume growth in the mattress business, 10 to 15% value growth in this business itself. Last year, the volume growth in the mattress business was just about 7%, with value growth a little higher. So overall revenue growth for this year, as per the company, could be anywhere between 15 to 20%. More specific was 15 to 16%. Spain business, which saw volume growth but not price growth last year. The company believes that the last 2 months have done well for them. Kurlon, the other acquisition that the company made, which will have synergies realized. They said that margins will increase to 10 to 11% from 7 to 8%. Even though there is some integration left in the front end of the business, back end has been completely integrated. The front end would be integrated by October itself. On the raw material prices, TDI, for instance, they have been pretty steady as well, hovering around that 200 rupees per kg mark. So there is stability. So that should work for their margins going forward. And what also should work for growth and margins on a very, very small base, premium mattresses which cost upwards of 20,000 rupees a piece, are growing at around 50 to 60%. So with all these factors, we would see business doing a lot better for Sheela Foam than what it had done in the last 1 year or so. So let's hear out what the management had to say to us, the insight that we got from the company's CEO, Rahul Gautam.
We are looking at close to 10% as a volume growth and close to about between 10 to 15% as a value growth. Spain is we have a very small market share in a very large European Union market, though the markets are shrinking and contracting there, but we are continuing to grow. Last year, we did see a drop in the top line, and that was primarily on account of the raw material prices coming down. Consolidation there would really bring about the increase in the bottom line and in the margins. So what was hovering more around 7-8%, we expect that to go up to between 10 and 11%, and that integration has done well. Although we are not yet a year away from the transaction, and we are beginning to see those numbers in the bottom line.
Okay, all right. That's the word coming in from Sheela Foam. The stock higher by 3%. We'll slip into a short break. When we come back, we'll get you more on markets, and we'll get connected with Vayu Garware, Chairman and MD of Garware Technical Fibers, on the business outlook. Stay tuned. Welcome back. You're still tuned into Halftime Report. Well, Garware Technical Fibers, that's the stock on our radar today. The company speaks about a good second half of 25, and it has surged 21% this year so far. They also expect growth on account of continuing good demand in aquaculture segment from Chile and Norway. To discuss this more and more, we have Vayu Garware, Chairman and MD of Garware Technical Fibers, joining us now. Mr. Garware, good afternoon. Thank you so much for joining us. Well, you know, there's been a margin improvement that the company saw in Q4. It has been strong versus the peers as well. Can you give us a sense of how raw material prices are panning out, and what is the margin picture that you're looking at in FY25?
Sure. Good afternoon. Thanks for having us on the program. Actually, if you look at a slightly longer timeline, up to COVID, we were growing very well. Post-COVID, we had a couple of years where we had some headwinds of some external issues in our sports business and aquaculture business in Norway. In 24, these are now behind us, and we have therefore been able to deliver a very good result in 24. We grew our profit before tax by almost 23%. We were also able to cross a key milestone for us of 200 crores profit after tax. This was partly with very good margin increase, so we actually grew our profit before tax margin by 3% points in 24. The demand outlook for 25 is also started very well. Our plants have been full through the first quarter, and we continue to have full capacity utilization. So we're expecting a very good first half in 25, and the margin profile is expected to continue. Raw material is not a major concern for us because we do pass through maybe with a lag. Our pricing is much more around value proposition. So raw material is not a significant concern.
All right. You said that you are looking at a good first half. If you could, quantify what good first half means, because last year, if I look at your peers and you grew about 2% on the top line, whereas some of your peers actually fell, mid-single digits or even low teens for a couple of them. So what do you expect the industry to do in this year, and how much will you beat the industry by?
Very honestly, we don't focus so much on top line. Our focus is a lot on the profit, and that's why I said our profit has grown by 23% or so. So we're very much on track on that. We look at continuing that even in 25. In the first half, it should be in a similar trajectory. On the top line, there have been some impacts. For example, a lot of our business, 60% of our business is overseas. So freight rates dropped a lot, which obviously is a pass-through to the customer, etc. So it impacts the top line numbers. So I mean, we don't track the top line as much as we do on the bottom line.
So what happens to the margin number then? Will you be able to maintain the levels that you saw in FY24, or will you see an improvement over those levels as well? Because you're talking about good demand, more addition of value-added products in your portfolio.
Yes, so we expect to continue the margin that we were able to deliver in 24, and with some improvement. There are two key focuses for us. One, of course, in our company, roughly 80% of our products are already value-added. 20% are still commodity. And a key focus project for us is to improve that balance 20%, which is one of our key strategies. And that's working quite well so far. So we will expect over the next couple of years that we will further improve the margins a bit. So we do expect to maintain and improve from there.
So if, say, for instance, revenue is a function of, the prices, etc., and you don't focus on that as much, how should one look at your operational performance? Do we look at it as EBITDA per unit? And if you're looking at growth in this year, are you making some sort of metric of volume growth as well?
We do have, but part of our core strategy is also that we go on upgrading our customers. So sometimes that leads to cannibalization of our own product, but with a much better value-added product. So therefore, I say that as a strategy in our company, we don't look so much at top line and volume. We're finally trying to deliver to the bottom line, and we deliver a lot to our ROCE. So if you look at our return on invested capital, it's over 50% now. And that's what we really focus on.
Okay. You did indicate that export is a big part of your overall revenues. Norway, Chile, and Northern Europe is where you see a lot of demand coming in from. Is this expected to sustain? What is the export domestic mix right now? Are margins better in the export markets for you?
Yeah, our export domestic mix, we're about 60% export, 40% domestic. Overall, margins are similar. Our margins in some of the international markets are better than domestic. But internally, we have decided to refocus a bit on domestic. So our intention over the next 3 to 4 years is to bring domestic up. There's been some restructuring we've done internally to build a greater focus on domestic, and particularly bringing some of the value-added solutions more into the domestic market. So, over the next many years, India is definitely going to be one of those countries that's growing, and we want to refocus on this market as well. So we will look to try and bring it back. Domestic will increase again from 40 maybe to 45+% over the next few years.
All right, so you'll increase your domestic contribution from 40 to 45%. I have to ask you this, and it's the time, right? We celebrate a lot of sport. Then we have the Paris Olympics, and yesterday there was a report that came in which suggested that we have seen a growth of 57% demand in turfs across India. So sport, which the last known number was close to around 15% of your overall revenues. How much is that right now? At what rate is it growing? What rate is it likely to grow at? Is that margin accretive?
Yes, it's very much. It's a high margin business for us. It has grown over the last 7 or 8 years at almost 15% CAGR. So it's consistently growing well for us. As I mentioned earlier, only in 22 and 23, we had some challenges, largely out of the US market, but that's over. And 24, we're back to very good growth on sports. We have not so far focused in Southern Europe and South America as much in sports. So those are the new markets we're focusing on that area, and that should further add to this growth rate. But
how much does it account for?
Key area. Sorry.
How much does it account for in your overall business?
It's close to 20% of our business now.
Okay. And are there any other capex plans that you have in any other new segments, or will you look at expanding the sports segment itself? What kind of plans in terms of expenditure do you have in FY25, or say 2 to 3 years down the line?
So we roughly invest in capex about 50 crores per year, and in 25 also we plan to do similar, maybe a little bit more. The demand has been very strong, so we will probably go a little bit ahead of that, but not significantly, maybe 60 crores or so. But that in our business, it's not a single line. We add machines as we require. It's more like a textile process, so we can add and debottleneck as we require. So roughly 50 to 60 crores is what we normally do, and that should be sufficient to keep it.
All right, and finally, before we let you go, any other category that you're looking at in terms of premiumization, growth, any sector which shows the makings of a big one for you?
I think geosynthetics is one of those. It's been a very strong last few years. Profit growths have been roughly about 40% per year over the last 3 years in geosynthetics. and it's a very high ROC business for us. So this is an area where there is a specialization. There's a lot of value addition in infrastructure through geosynthetics. And we are looking at both within India as our major market, but also outside. So we started export in this segment, and that's also growing right through Europe, South America, and Southeast Asia.
Okay, all right, Mr. Garwari, it was a pleasure speaking with you. Thank you so much for joining us and giving us all the details. We'll touch base with you once again when Q1 numbers are reported as well. That's the word coming in from Garwari Technical Fibers. They expect growth to continue and margins to improve in FY25 and looking at new segments as well. Time for a break now. Manish Hatirumani of Deen Dayal Investments will join in with some trading strategies on the other side. Stay tuned for that. Welcome back. You're still tuned into Halftime Report. Some of these consumer names, they have touched a high for the day at least. Nestle India, Britannia, HUL, all these three stocks should come up for you on the screen. They are at the day's high. And there are some stocks which are supporting the Nifty from the lows as well. So these are some of the names you should keep on your radar. But this is a time when we talk about the FNO setup of the day. Mangalam has gone to that big wall with the FNO setup. Mangalam.
Well, you know, if you just take a look at the way the indices have moved today, it's the Nifty Bank which is down about 500 points, so pressurizing the Nifty. But the Nifty, despite that, has been very resilient, has recovered from the lows and is all but into the green right now. The mid-cap index doing a lot better because when the mid-cap index moves higher, it tells you that maybe the street expects some support at lower levels for the frontline indices as well. And that's a story that, you know, the contribution chart will tell you a lot better. The Nifty is down 18 points. HDFC Bank is actually down 126 points. So had it not been for HDFC Bank, the Nifty would have actually been higher by almost 100 points in today's trading session itself. So that's something that we'll have to watch out for as we move along as well, because for HDFC Bank, you know, it has all but given up the entire gain that we saw for the MSCI inflow sort of trade. Last week, it was at 1684. July 3rd, when the news came by and the stocks saw a big move, it moved all the way up to 1769. And now, where it is 1652, it is extremely important to hold on to these levels. Why? Because 1650 put has seen maximum open interest. And from a technical standpoint as well, 1650 has the 20-day moving average. So where HDFC Bank goes from here will be extremely crucial. On the way up, of course, 1800, which is the previous high, and a lot of call writing that we've seen out that as well, would be a bit of a resistance zone. For the Nifty, 24,200 put writers are very active at a premium of 80 rupees, telling you 24,120 is a strong support. In fact, yesterday as well, we spoke about 24,100 to 24,150 as a support zone. However, on the way up, 24,400 is an important congestion zone. Why do we say that? Because of the 200 rupee premium available at the 24,200 call itself. So those are a couple of levels that we're watching out for. For the Nifty, a range of 24,150 to 24,400. A lot of long positions are in a couple of names. We have Loris Labs and Divi's Labs, both of them seeing a lot of open interest action. And the one stock that I'm watching out for today is GNFC, may enter FNO ban. Remember, we spoke about ABFRL, Bandhan and PEL entering FNO ban yesterday. They did. So now let's watch out for whether GNFC enters the FNO band.
Okay, all right. We'll watch out for that one. Thank you so much for joining us. So with that setup, Mangalam, Manish Hatirumani of Deen Dayal Investments is joining us now. Manish, good afternoon. Thank you for joining us. Well, what is the next important level to watch out on the Nifty and any individual tech picks you have for us?
Good afternoon to you, Sonal and Mangalam. I think Mangalam kind of has the same levels as I do. I'm working with very, very similar levels. Because last week when I was on the same show, we had discussed 24,150 being a resistance. That same 24,150 today has become a support, and that is really where we have bounced from. Am I really excited to go long immediately? The answer is no, because this 24,350 to 24,400 has been testing patience. We might be having a gap opening like we had yesterday, but we were not able to hold on, and we were not able to cross it either. We went ahead and closed below that. 24,050. This is one level that I would be watching very, very closely, because if we do break that, that exhausts one of the gaps. And that could take the stock down maybe by another 200, 250 points, and Nifty could fall. Until then, I'm working only with some of the mid-cap names because I still feel we have a long way to go with the indices.
Okay, all right. And any individual names that you would like to suggest?
So I'm working with two mid-cap stocks. The first one is on a Bharat Forge, which is for a target of 1710, stop loss of 1645. The stock was in a short-term correction, and we have now turned positive on the back of good volumes. The second one is on Indian Hotels for a target of 650, stop loss of 600. With a strong base building around the 590 to 600 levels, the stock has bounced into positive territory.
Okay. All right, Manish, thank you so much for joining us today. So those are some technical bets. We'll slip into a short break. When we come back, we'll get you more on the markets and we'll connect with Prashant Mehra, partner Grant Thornton Bharat, to decode deal activity in Q2 of 2024. Stay tuned.
Welcome back. Let's focus on the deal street and on the deal tracker segment. Today we have with us Prashant Mehra, who's the partner at Grant Thornton Bharat, joining us now. They've authored a detailed piece on Q2 transactions. Now, Prashant, very quickly, the key highlights on where the deal street is headed at the moment. Of course, we had a big event like the election results, which also had put a little bit of a slowdown on this particular street. But now we have the budget to look out for. How is corporate India as well as private equity looking in terms of conversions in deals?
Hi, thank you for having me once again. I think, as you rightly put, the quarter has seen very impressive growth, especially if we relatively compare it to last year. But I think it's been still subdued because there was an overhang of the elections which were scheduled in June. So I think, that continuation and political stability has only been validated, and we will see even further growth. I mean, specifically, if you see, the large part of the growth that has come from and the activity has really been around domestic consolidation and domestic M&A, which shows to prove that, the large corporates continue to believe in the brand India and are thus investing even more and more in domestic companies and moving towards consolidation and strategic acquisitions. But I think, the other part of transactions, which is really inbound and outbound, hasn't seen much growth. And I think that's really what will show even further traction in the next quarter or two. As far as private equities is concerned, I mean, we all know they were sitting on a lot of dry powder. The valuations have come down. I would say, they are more reasonable. The value per transaction or the funding per transaction has come down. So while the volume has increased, the value has not increased as much. But I think that's quite reasonable, and we were expecting that. And we will see even further private equity coming in, especially private equities, backing mid-cap and high-growth companies on, again, domestic consolidations and strategic acquisitions.
But Prashant, with equity markets really running high, that doesn't augur well for the deal street as well as the conversions, because a lot of talks which earlier started are now becoming obsolete because of the change in the valuations in the public market, and that also has a serious impact on the private market transactions. So deal conversions have been slow, especially in healthcare. We have seen 3 large transactions. One went into cold storage and the other 2 are going very slow. What is your view on deal conversions and the impact of equity market valuations on the deal conversions?
I think there are 2 things here. If we look at the IPO markets, which is the obvious exit point for any investor, the IPO markets are back again, but with a slight difference. We are seeing fewer IPOs, but with very successful IPOs, and these are large IPOs. And I think that's the trend that will continue. The market's kind of, giving the message that we only want large and strong companies which are looking at that next level of growth and not really mid-market and dynamic growth companies as such. And I think that opens up a whole plethora of field for these mid-market companies and high-growth companies to be funded and backed by alternate capital, which is private equity, to grow further in terms of M&A and inorganic growth within the domestic market. In fact, even look at transactions overseas. Valuations have to be reasonable because you always need to leave something for the for the markets to absorb once it is listed. But I think it's kind of an evolution which I see a more positive outlook. The mid-market transactions will increase, and IPOs will only be on high growth and matured companies as such with a large base.
That's right, Prashant. You mentioned IPOs. So block deals, IPOs are, something that have been in vogue on the deal street more. And that also gives a sense that private equity as well as venture capital is more on exit mode when it comes to large transactions. How do you see it from now on?
Yeah, I think, the sectors will really play out. In the last quarter, we've seen some activity around manufacturing, retail, and I think that activity will only increase. We were only talking about, the evergreen sectors, which is technology, healthcare, but, investments coming into infrastructure as such. I mean, we've had some very large transactions there, investments coming into retail, investments coming into pharma. That really shows that, there is a 360-degree growth aspiration that investors and transaction makers have, and it gives them even further confidence in the brand India. I think, the next quarter or two will be good to watch out for. I personally expect that, once this political stability has been validated, we will definitely see a lot of inbound and outbound traction, which should really be the flavor of the season for H2 of 2024.
So, Prashant, the final question from my end, where is action picking up? Of course, we saw one big coup from Ultratech in the cement sector for India Cements, and there's a lot of competition in cement acquisitions. That sector is buzzing. Which are the top picks when it comes to sectoral play, which is going to see maximum amount of deal flow, according to you at this point?
I mean, I wouldn't mention the usual suspects, which is really, technology as such. But I would see a lot of traction in the consumer sector as such, whether it is retail or whether it is services. The other sector that I would pick is banking and finance, because whenever markets are up or markets are down, that's one sector that always shows some traction. And I think the third would be infrastructure. So infrastructure, banking and finance, and retail would be my 3 picks.
All right. So those are the few sectors. Of course, there is intense M&A competition that will pick up amongst the conglomerates is what we see, Prashant. And the VCs and private equity continue with their stake sale if equity market is really revving up at this point. So they're taking this particular opportunity. But great speaking to you as always, and speak to you next month again on the top deal trends, and hopefully post the budget, things would be clearer. Thank you so much for joining us right here on CNBC TV18. With that, we'll slip into a short breather, but come back for more news and updates and market action on the other side.
Welcome back. Britannia is one of the stocks which has now moved to the high point of trade. A couple of these FMCG stocks actually now, rising and doing extremely well. And from the broader markets, we have United Breweries and United Spirits. United Breweries actually has taken the biggest up move in the last few minutes or so. It's a 5% up move, 3% away from its record high on that stock. So move away from Britannia, pull up something like a United Breweries, and you'd see a big move is what we're seeing as we are awaiting good numbers coming in from this summer itself. United Spirits mildly in the green. But the Siemens AG chief tells our colleague Lata Venkatesh that his company will eventually sell its entire stake in the to-be demerged entity in India to Siemens Energy. Hints that Siemens Energy may actually want to sell some of its stake also in the Indian market. Listen into that important conversation and come back.
Siemens Energy sold stake in Siemens Limited to Siemens AG. So now you own 69%. Was that just to help Siemens Energy out of its intermediate financial problem, or was there any other goal in increasing the stake in Siemens?
There were actually, number one, the whole discussion was indeed triggered by how can we provide very quickly cash for Siemens Energy, and we did. But the other element in it was that once we have that step and we bought them out, By the way, the agreement is they buy it back later on. This is clear because we don't want to sit on it. But that triggers now a kind of an autopilot process to really disentangle Siemens from Siemens Energy, also in India. And this autopilot started already, and we go.
With Siemens Energy being demerged.
It will be a spin-off, so that you have two companies with the same shareholding, and then we can get out.
No, I'll tell you why I'm asking you this question. You must have heard that Hyundai is doing an IPO in India of their India unit. The Indian stock markets are in a giving mood.
Yeah.
So would you want to use that? Would you want to keep 69% in both Siemens Energy and Siemens Limited? Or would you want to give some stake in the Indian, divest here, simply because the market's in such a good position?
Our ultimate target is obviously to dilute our share from Siemens Energy down to zero. This is what we committed to the market on a global basis. Same here on a local basis. That's what we're going to do. And this is the whole meaning of this exercise, what we're going to do. So we will let Siemens Energy go. They stand on their own legs.
As an independent unit.
Exactly.
But will that entire 69% be sold to Siemens Energy? Or will divestment also be a part? Again, because you're likely to make a lot of money. The market is happy with valuation.
Absolutely. This is depending on what Siemens Energy is going to do. I think the likelihood is that this goes down, but I think this is another question. At least from our part, it's clear we want to get out of it, and we will get out of it.
Okay. I hope you know you're trading at 70 times. I'm sure you know.
I do know.
70 or more.
Isn't it great?
So it is great. That's why I was asking. It's a great time to cash in, and Hyundai is showing the way.
Oh, yeah.
So we are asking all multinationals if, they are tempted to come to the Indian market. You will consider that.
We are very happy with the development here, I have to say, and hope we can continue.
No, I'm asking whether you will divest very clearly.
On Siemens Energy?
To the market.
The point is, we are divesting our shares in order to bring it down to zero. The receiving end is Siemens Energy. The assumption is that Siemens Energy will definitely go for 50 plus 1, and the rest might go to the market. I don't know, but
that is their decision.
Yep. Interesting insight out there from the Siemens AG head on what they plan to do with the India business. Will be very important to see how that goes about. Take a short break, come back. We focus on the commodities arena. Manisha Gupta joins in with what she's had.
Welcome back, and joining us on the show now is Deepak Balani. He's Director General at ISMA. Mr. Balani, thank you so much for joining us. And even before we get to what the sugar as an industry is anticipating from the government, from the budget for that matter, I do want to understand the maths of sugar completely, because I do understand that ISMA and various other sugar companies that we speak to have been putting forth this proposal of letting the industry export a couple of million tons of sugar perhaps. So what is the calculation? What is the maths that you're working with?
Yeah, hi. So basically, as you know, that in current season, by end of 30th of September, which is the end of the current sugar season, we will have a substantial higher closing stock of around 9 million tons. And considering that the government wants around 3.5 million tons as a safety, 5.5 million tons as a safety net, we still will have around surplus of around 3.6 million tons. And the next year projection looks to be better. What was perceived around 2 months back that the 24-25 production will be substantially lower, but considering that we are getting good monsoon showers across the country, and specifically in the states where we have a lot of sugarcane production, we are hoping that the production will be much better than what was expected a couple of months back. So considering that, I think we will have substantial production for catering to our domestic consumption, for catering to the ethanol program. And even after that, we should have around 1.5–2 million tons to export. So we have requested the government to allow export of around 1.5–2 million tons. And that, if done, will be a big relief for the industry, and also will ensure timely payment and timely realization of the payment to the farmers.
Deepak, until what time do you think it makes sense for the government to actually allow on-ground 1.5 to 2 million tons of export?
We are hoping it should come as soon as possible. And I think ISMA will have the next year projections of the sugar production by end of this month. So we will have our first official estimate on 30th of July. And I believe considering that maybe this month end or early August, we hope that the government will take some decision on this.
Deepak, also comment on the ethanol part of it, because would you say that the government first will look at consumers and then the ethanol diversification, which we do know is slightly lower as compared to last year? Do you see an increase in that because the government would want to ensure that the projects or the timelines that they have put out in sense of blending should be achieved?
See, government has already announced after the new government has taken over, they have already announced going forward blending of 20%, which basically results into a requirement of around 988 crore litre. And the sugar industry is committed to supply at least 55% of the ethanol. So I think going forward, we are poised to give substantial 55% ethanol. And I think equal amount of sugar could be diverted. And I think we are in a good situation where we will have the closing stock, good closing stock, and a much better than expected predictions.
I am sure you would have a long list of budget expectations, but one thing that comes to my mind, one, of course, is the formula that the industry has been putting forth, whether it's about sugar or ethanol pricing would be top of the list. Also, the sugar minimum selling price has been stagnant till 2019. Is that yet another thing that you guys are pushing for?
Yeah, obviously. See, MSP was last revised in 2019. And after that, year on year, the FRP of sugarcane has been increased. The input cost has gone higher. Inflation pressures are there on the mills. I think it is imperative that now that the government has already announced the FRP of next year, and considering the cost of production, which has also gone higher, the government also increases the MSP of the sugar. And in fact, we have requested them to institutionalize this and create a kind of a formula so that whenever there is an increase in FRP, there has to be a corresponding increase in MSP, which basically ensures that the economic health of the industry remains good, and we are also able to pay to the farmers on time. So I believe government will look at this sooner. And if it is done, it will be a big relief for the entire ecosystem.
It sure would be. Deepak, so what is it that you're looking at in sense of top priority, apart from these concerns that the industry has been putting forth for some time now? This is the budget time. The finance minister would look at all the sectors. Sugar is one of them as well. So whether it's about GST or various other subsidies that the sector is looking for, what is top two of your mind?
See, basically, we are looking at, so we need to work on enhancing the consumption of ethanol, because the capacities are increasing. We also have grain capacities coming, sugar capacities are also increasing. So we're looking at, also we need to also consider the mind that we have to reduce the carbon emissions. We have to work on how we can reduce the greenhouse emissions and achieve the climate goals. So for that, we have requested the government to reduce the GST on flexi fuel and hybrid vehicles from 28% to 5%. A similar kind of incentive has been also given to EVs, and we have seen what it has done to the EV sector, so that total cost of ownership for the consumer goes down, and we will have increased use of such carbon neutral or zero carbon neutral emission vehicles. So that is number one. The second demand is also to have a differential price of E100 and also to reduce the cost of the E100 fuel. And the GST component may be brought from 18 to 5%. And one of the most important proposals which we have given to the government is basically to come out with a national mission on sugarcane, where we are looking at enhancing the productivity of sugarcane farmer in terms of yield improvement. So that, and we have identified around 55 to 60 districts in the country which are water stressed, so that if from the existing schemes, for example, per drop, per crop, then we have watershed development, crop residue management. If an allocation of 38,000 crore could be done for this particular component, it would really help the farmer to enhance the sugarcane production, so that we also are looking at around 20% enhance in the production of sugar. So I think these proposals, if could be considered, will not only help the farmers to enhance their income, it will
also made the sugar industry more sweeter, I'm assuming.
Interesting insight out there. Thanks a lot, Mr. Balani, for joining in with your suggestions and recommendations. Thank you, Manisha, for taking us through with that conversation. With that, we're out of time on this edition of Halftime Report. The news that there has been some recovery for the frontline index. The mid-cap index is not stopping. In fact, it's only gained further from the time we started the show at the high point of trade. So we'll take our break, come back on the other side. We'll have business lunch, take all the market action ahead.